Welcome to this McKinsey Global Institute virtual event.
Hi everyone, welcome to our webcast from the McKinsey Global Institute. I'm Chris Bradley, I'm one of our directors. I'm going to take you through a brief presentation to highlight the findings of our recent research on investing in productivity growth. And then I'll hand over to a panel run by my colleague Olivia White with Eric Brynolfsson and Nathan Sheets. So thank you for joining us, and we look forward to a rich conversation together. So let me first take you through some of the highlights of the research. Of course, you can go as deep as you like by downloading our report and reading for yourself. Now, the last 25 years has been an incredible time for productivity, actually. In this report, we did a really big step back of what went on in the world of productivity. And what we found was a miracle of productivity growth. When we started this period 25 years ago, the median worker had output of $7,000. But at the end of this period, that number had jumped sixfold. And what you'd see from these curves is it was a miracle of the middle. This was about catch-up, and primarily about catch-up growth. It was about bringing modern economic prosperity to billions more people. And this was a time of great success on productivity. And if you look at where it came from, half of that productivity growth came from just two places, China and India. And if you add all of Asia together, it's about 2/3 actually an Asian story. Now, North America, of course, still matters a lot because of its size, but half of it came from those catch-up economies. Now, the critical link we draw in this report is between productivity and investment. There's lots of ways of measuring it. The way we measure it, we think productivity is 70 to 80% in the long run about capital deepening, about more capital per worker. And what we can see here is in those economies where we had this huge surge of productivity, underneath that was a huge surge in capital. So the amount of capital per worker in China by the end of the period was 8 times bigger than the start of the period. Another way of thinking about it is China and India attracted 45% of the world's net capital over this period. So 45 cents in every dollar of net capital accumulation went to those two countries. About 15 cents, by the way, went to the US, but only 9 cents went to Europe. So capital really, really mattered. Productivity is built on the back of investment. Now, it's also true that each country and region carves its own productivity path. And I mentioned the word catch-up economics before, and it's an obvious truism of economics, maybe made most famous from Robert Solow, that the level of productivity growth I should expect will depend on my starting point. So North America and Western Europe, the most advanced economies in the world, kind of are at the frontier of technology and would be setting the pace, and they would average, in the long run, around 1 or 2 points of productivity growth. What we see, though, there is a productivity growth frontier. There's places like China and like Central Europe, and at an individual country, places like Vietnam, that seem to perform at the top of their class based on their starting level of productivity. And they're in what we call the fast lane of productivity growth. And those countries near that curve are growing fast enough that within a generation, 30 or 40 years, they can actually catch up to the advanced economies. But there are countries in the middle lane as well, like Indonesia. They're going to take maybe 100 years to catch up if they keep growing at their rate. They're growing productivity a little bit faster than the US, but not fast enough to catch up in any meaningful time frame. And then, of course, there's places like Sub-Saharan Africa and LATAM that actually are growing productivity slower than the leading economies and therefore will never converge. So it's interesting. Convergence kind of happens for some. It's happening in the fast lane. There's a great opportunity in the world to make convergence happen in more places because this is the biggest force we have for global prosperity. Now, I talk about a productivity miracle. But it was a decelerating productivity miracle everywhere. It didn't matter if you're in the fastest growing productivity places or in the advanced world. Something happened after the global financial crisis. And we had a deep, deep slowdown in my country in Australia. Since 2016. We've had zero productivity growth, even though we were one of the best productivity growers in this first period. But in particular here, you can see the slowdown in all of these Western economies. And this really stokes our curiosity. Why is this slowing down? And what hints are there for us about maybe how we'd get the engine of productivity running again? And surely we need it. We need it now, perhaps more than ever. So let's have a look at how this productivity evolved in the US. And the McKinsey Global Institute started in the 90s, and we kind of made our name doing productivity studies. And one of the more famous studies from the 90s identified something called the Walmart effect. This was when we showed that a huge part of the productivity boost that the US was getting in the late 90s was from the emergence of this big box retailing. It turns out, of course, that productivity is not a very even affair. It tends to be very lumpy across sectors. And productivity miracles happen when certain sectors do really big things. And it just so turns out that in this fast period of productivity growth in the US, there was four sectors doing big things. Big box retailing was happening. ICT was beginning to show a prolonged period of high productivity. The computing and semiconductor industry was benefiting from Moore's law. And broadly speaking, overall manufacturing had a massive productivity boost from offshoring. And we know that because we saw the capital stay consistently high and the labor get rationed to the most productive uses. So it's like a giant wave, isn't it? But the funny thing is, after the GFC, the wave kind of never bounced back. Now you see a bit in towards 2019, but not a sustained bounce. So when we decompose that, there's more theories. There's so many theories about what happened on productivity. We decided to say let's try and just really diffract out the different drivers of this productivity slowdown and figure out how do we explain 80 or 90% of it. And it turns out we can explain almost all of the productivity decline with just a few things. The first one is hinted at before, where those giant manufacturing waves in electronics and in the rest of manufacturing, those waves came to an end. But there was something else that was happening too, and that was a collapse in the level of investment that collectively explains more than half of the decline in productivity. And that brings us back to one of our key themes about investing in productivity. And it's quite a startling picture actually if you look at what happened to net investment after the GFC. And for many of us, it's a great puzzle, and maybe some of our panelists can talk to this later. But why, in an era of extremely cheap money, did investment go down rather than go up? And so this lower net investment follows through in the growth of capital per hour, which is an incredibly important number to us, being lower almost everywhere after the financial crisis than before. And, this mattered. This was 70 basis points of reduction in productivity growth. So now looking forward, how do we take this maths and think about it in a forward-looking context? Well, it's quite a different environment we're going to have to solve in. First of all, we're going to have to figure out how to reverse the slowdown. And we think there's great hope. First of all, we should be able to revamp investment. You can see a very clear link between investment and productivity. But also something obviously our panel's going to talk a lot about is this next wave of automation and AI holds a great promise to provide quite a big boost to productivity, all things being equal. Our research puts it at 0.7 to 1.7 potentially. Could be more, it could be less. There's obviously many reasons for the ranges. But in addition to reversing the slowdown, we actually have to deal with some pretty full-on headwinds and headwinds on productivity. First, we're going to really start hitting aging in some economies, particularly like Japan, Germany, Italy. That could have a 50 basis point hit. Hybrid work looks like it's a wash at this point, but it's uncertain what it's going to do. The slowing down of globalization and the relocalization or reshoring of some supply chains could take away what has been a real tailwind of productivity growth and turn that into a headwind. It doesn't have to, but it could. Also, the energy transition in the short term looks expensive. It looks like it could, be, 10 to 100 basis points of cost in the short term, not only because of the dislocation of quite high productivity jobs in that sector, but also the flow and impact of high energy costs. Now, in the long term, it could be very positive because you're unlocking a lot of efficiency through electrification. And then finally, in services, in all modern economies, there's a drift in our economy towards services. This is a perpetual drag on productivity. It's always been there. But this could be worth another 10 basis points. So we're entering into what I'd call some choppy waters of productivity, but with a great hope as well that AI might do what digitization couldn't. So why do we have hope? Well, AI is not just fluff. It's hard stuff. It's big investment. If we look at what these big six tech firms are doing, they've increased their sunk investments, so R&D and capex, by 7.5x. So these six companies are spending $411 billion a year. So Microsoft, I think, is aiming to build 10 data centers, and 10x the rate of data centers that it thought it was going to have to build 10 years ago. This is a very physical phenomenon that's driving a massive boom of investment. But there's also, obviously, we're excited. I like this story about Gen AI because it's very close to home. This is an experiment done in England with patients and doctors. And they knew they were talking with either a real doctor or a chatbot. The interesting thing is afterwards, after their medical appointment, they had to rate both the quality and the empathy of the experience. And, as you'd expect, physicians did okay on quality and, maybe some improvement to be had on empathy. The surprising thing, of course, is not only did the chatbot perform much, much better on quality, but also on empathy. So you can imagine the amount of applications for which agents or co-pilots could be enhancing our productivity. And we start getting excited about the productivity potential as being very real. So the McKinsey Global Institute has done quite a detailed analysis of this, working bottom up from jobs and tasks and capabilities, and ask ourselves, well, out of the thousands of jobs comprised of thousands of tasks and dozens of different capabilities, which parts of those jobs are replaceable by machines? And we've had to, since Gen AI was invented, kind of radically update our models because it brought many, many things forward by 10 or 15 years. This is our current view on automation level of work activities. In the mid case, you're getting to about, in 2035, about 1/3 of the tasks we have today can be automated. Now, let's do the maths very simply. If in those, so that's in 10 years, 33% of time freed up. If those jobs go straight back into the economy at the same average level of productivity, and we don't have to pay for it, then, you've added 300 basis points a year of productivity. This is a huge potential tailwind. Now, of course, that's a crazy number. That's far too high because there'll be lots of costs of of that transition, and maybe not every job will go back at the same productivity level. But you can see why it doesn't take a huge amount of maths to understand why this is going to have an absolutely substantial outcome for our productivity. So with that, I'll hand it over to Olivia and our panelists. And in particular, we're excited to invite your comments and questions as well, and make this a conversation about a topic that's just of such vital importance to the prosperity of the world. Thank you.
Thanks, Chris. And I'm delighted to be joined in conversation by Nathan Sheets and Eric Brynjolfsson. Nathan is the Global Chief Economist at Citigroup. Eric is a professor at the Institute for Human-Centered AI at Stanford. He's also the director of the Digital Economy Lab at Stanford too. And he is the founder of WorkHelix, which launched to the public 2 weeks ago, and he may say something about what they do during our conversation. Nathan, Eric, great to have you here.
Great to be here.
I thought we might start with talking about the prospects of productivity growth, at least in the near-term future. And if you read the US news, you see, well, the past 3 quarters, maybe arguably the past year, productivity growth has been growing at 3%. So Nathan, what do you think of that? Is that a blip? Are we actually really on an elevated path? How to interpret?
I think it's good news. Whenever I see higher productivity numbers, I find it encouraging. I think it's fair to say that from a macroeconomic standpoint, productivity growth is about as close as you can come to a free lunch for the economy. Now, maybe the more sobering perspective on this is that I'm still interpreting these numbers as very much a cyclical phenomenon, that productivity has been significantly affected on the upside, on the downside, and I think to some extent on the upside by disruptions and displacements associated with the pandemic. And broadly speaking, I think that these numbers are reflecting ongoing normalization of productivity back to what at the moment looks to me like a trend of about 1.5% a year. I think that's roughly where we are. And then I think going forward, there's a debate regarding AI and how transformative that might be. And I'd say I lean toward being an optimist on that. But the bigger debate is kind of when we start reaping those benefits. Is it likely to be in a 1 to 3 year horizon, or is it out down the road?
Eric, your take?
Well, a little over a year ago, a couple of years ago, I was talking about how Gen AI was going to surge, and now we see a productivity surge. It's very tempting to take a victory lap, but unfortunately, I have to agree that with Nathan, that what we're seeing right now is not yet the AI-driven productivity surge. It's just too soon. We're seeing some green shoots in a number of specific applications that are great, but what's happening at the macroeconomy right now is more of a cyclical thing. I remain quite optimistic, even though these particular numbers aren't what's driving it. What's driving my optimism is what I see on the ground with Gen AI and a lot of other related technologies beginning to fundamentally transform how business is done, and in some cases leading to double-digit productivity gains. But the applications are still fairly narrow, and as they broaden to the rest of the economy, it'll start showing up in the aggregate numbers.
I want to get to the specifics and the micro of Gen AI shortly. Before that, Europe. Where's Europe right now? And I don't know if you have a view, Nathan.
Yeah, the productivity story for Europe, I think at the moment is somewhat softer than what we're seeing in the United States. And specifically, I think one of the puzzles of this cycle for the European economy is you've had both simultaneously weak real GDP growth and a very tight labor market. And if you just do a simple calculation of these recent data, and calculate productivity growth, you're going to get very soft readings for productivity. And I think there may be some of that going on in the data. And specifically, I think that the German economy, for example, has some deep structural challenges. And the next 5, 7, 8 years could be quite difficult. So it's hard to be too optimistic about productivity, at least in that major part of the euro area. But by the same token, again, in Europe, I think there's an important cyclical dimension to this. And specifically, I think we're seeing a manifestation in a very big way of labor hoarding, and that firms are doing everything they possibly can to hold on to workers. And they've learned through previous cycles that as you lay workers off, and eventually the economy recovers, and you've got to go out and find employees. And that's a costly proposition, the finding cost, the training cost, and you may lose business opportunities. So I think labor hoarding is a big part of the cyclical story in Europe at the moment.
Eric, for Europe, but also more broadly, you mentioned the micro underpinnings of AI and Gen AI and how those actually impact jobs. What are your thoughts?
Yeah, well, first on Europe, in addition to what Nathan was saying, I think that it's just not as dynamic as the United States. The United States is much less dynamic than it used to be, and not as dynamic as it should be. But there's still more dynamism in the sense of companies being born and dying, and employees moving from company to company. And that's what's needed to really get some of these benefits. I mean, to give you some concrete examples of how Gen AI is beginning to change companies, along with Lindsay Raymond and Danielle Lee, we did an in-depth study of Gen AI being adopted in some companies in a contact center situation. A company rolled out Gen AI in a phased way. They did some A/B tests. They did some phased rollouts, which for me as a researcher was great, because we got to see kind of causal estimates of what happened when it was rolled out. They were using it to augment workers rather than try to replace them, which turns out to be most often the right approach. And the numbers very quickly were quite large. Within 4 or 5 months, we had about a 14% productivity gain on average. Strikingly, for the least experienced workers, the numbers were closer to 35% productivity gains. They were significantly outperforming people who'd been on the job for a year or more. We also saw higher customer satisfaction, better customer sentiment. That is, if you kind of looked at these millions of transcripts, you could see the number of happy words and angry words, and there are a lot more happy words. And even the employees did better. We were worried to turn it into maybe a kind of an electronic sweatshop with the AI more closely controlling what they were doing. But the workers actually had less turnover and were happier as well. So really all three of those groups, the stockholders, the customers, and the employees were better off. These customer service applications are becoming one of the main uses of Gen AI, and it's catching on very rapidly. We're also seeing it in coding. We're seeing it in more and more sales applications, in management communication applications. There have been other studies that have found patterns very similar to what I just described. And as that becomes more widespread, I think we'll start seeing it show up more in the aggregate numbers.
So let's talk maybe about what more widespread would mean, because all of the applications you've mentioned clearly are important, but tell me if you all disagree. I don't think they're going to drive the overall sorts of productivity increases that we might hope for in the future.
Let me say a little bit about that. So one way to understand it better is what we call the task-based analysis. And so with Tom Mitchell, I wrote a paper in Science looking at 18,000 different tasks. And then more recently, there's a nice paper by one of my former students, Daniel Rock, who's now a professor at Wharton with a team at OpenAI. And they looked at where Gen AI would be affected. And they found that, let me see if I can get these numbers right, about 80% of occupations had at least 10% of their tasks would be affected. So that, most occupations would have some significant amount. And 50% of occupations had 19% of occupations had at least 50% of their tasks affected. So really quite a dramatic effect on those. That's not that they're happening yet, but those are the ones that have the potential for Gen AI to be significantly changing what they're doing. And if you multiply through, anything like the numbers we saw in the ones where they're already applied, often double-digit numbers, and some of the coding ones even triple-digit productivity gains, times that number of tasks in the economy, then you start seeing several percent productivity gains. But I think that one of the big barriers right now is that there's just a lot of hype and confusion and really nonsense, to be honest, about what Gen AI could do. And I think the average CEO doesn't have a good way of prioritizing what's important. And so in this chaos, you're not going to harvest the potential benefits, and you need a way of prioritizing those tasks. That's one of the things my company, WorkHelix, tries to do. But I think the more data-driven the companies can be about prioritizing them, the faster they'll be able to identify which are the real places where the benefits exist and separate that from this noise that you see in a lot of the popular press.
Nathan, your thoughts?
Yeah, I think that this is really the key question for the macro economy. Is what are these limiting factors that are going to determine, and I've called them speed bumps, that are going to determine the timing in which this clearly powerful and transformative new technology has an effect on real GDP growth and macro productivity. And I think some of these things that Eric was talking about regarding the need to rethink business models, and how are you going to do that? What does the new world look like? I've also summarized that as we're still waiting for quote unquote that killer app for AI that's going to transform. A few other potential speed bumps. One is AI is a very hungry consumer of energy. And that's going to put pressure on the grid and energy demand in a time when we're focused on green transition and thinking about the energy and infrastructure support. Another big one is the regulatory backdrop. And how does Washington respond? And one specific concern that I hear mentioned over and over again, which can be a political concern, but it can have implications for business and society more broadly, is deepfakes. In this world where you can basically mimic anybody, how are we to be able to determine whether it's an authentic message from the President of the United States or the CEO of our company versus anybody else? And I think there's a lot of thinking to be done in kind of regulatory apparatus. Closely related to that is the legal infrastructure. So it leaves me, again, fundamentally optimistic, but maybe leaning a little bit toward this impacting the macroeconomy more in 3 to 5 years, that it's still a ways out. And I do think that is, and Eric may have some views on this, it's kind of a lesson of the diffusion of disruptive and powerful technologies into the economy historically, that the technology comes forward, people recognize its power, but it takes a while to really have that macro effect on growth and economic performance more broadly.
So, Eric, really a notion that you famously pioneered is the notion of a J curve, and the notion can you respond to some of what?
AI is an amazing technology. As Nathan said, it's a general purpose technology that's affecting all sectors. General purpose technologies like electricity, the steam engine, the first wave of computerization, one of their key characteristics is they trigger these complementary innovations. Some of the most important but less understood ones are the complementary innovations in business processes and organizational models that really take a while. The earlier ones, you could go through the history, and it's just striking how long it took, 30 or 40 years before the productivity gains really showed up from electricity. I expect it to be a lot faster. I think Nathan's numbers are more in the range for AI and Gen AI. There's still going to be business transformation needed, but this is a technology that many people can use without a lot of retraining. We've all played with ChatGPT, and you can communicate more or less in English. Maybe you can learn a little bit of better prompting and get a little bit more out of it that way. And certainly there are things companies can do to get beyond just the simplest applications. But the good news is I do think it's a lot faster. We have a digital infrastructure in place that allow us to, when ChatGPT, for instance, went from 0 to 100 million users in about 60 days. That's something that wouldn't have been possible without that kind of digital infrastructure. So I'm hoping it'll be compressed. Probably the most important factor in compressing it is managers understanding better what the opportunities are. I don't think there's any shortage of amazing, cool technologies, but understanding how those translate into productivity and business value requires a little bit more hard thinking and a little bit less hype. And that's the part we need to work on.
So you have please, good. No, go ahead.
Yeah, a related point that I think might be of interest is I spend my life speaking to institutional investors. And one of the questions I get asked is, at this stage, how does one invest in AI technologies? And my instinct is that if you look at the firms that are producing the AI, they're pretty aggressively priced at the moment. And you can debate, is it underpriced, is it overpriced? But at a minimum, you'd have to be a true believer to jump in on some of the direct firms directly involved at the moment. But where I think the money is yet to be made by investors, and this touches on what Eric was suggesting, is thinking about those second and third derivative effects of AI. Which industries are likely to be transformed most significantly as a result of this? And where are we likely to see on down the road the largest productivity gains? And I think that, suggestions, manufacturing is almost always a winner with new technologies. Pharmaceuticals, there must be something transformative that's going to be happening in data management. But I think this is really the big question for the investment community at the moment.
So, Eric, you have made a high-stakes bet on the impact that Gen AI and AI more generally might have on productivity growth, at least in the U.S.
Yeah, well, yeah, high stakes for a professor. So me and Bob Gordon, one of my my good friends and one of the most respected people in economics, but he's kind of been a pessimist about productivity, and historically he's been right to his credit. But looking forward, he does not see much productivity growth from these tools. I do. I made a bet with him that by the end of the decade, we would beat the Congressional Budget Office predictions, which I think were quite modest. They were saying 1.4%. I gave Bob an extra 0.4%, so we made it 1.8%. But I actually, I'm lowballing it when I bet with Bob. In other places, Martin Bailey and Anton Kornack and I have written that we think the number is going to be closer to 3%. Roughly double what the Congressional Budget Office has been predicting, closer to what we had in the 90s and early 2000s. So it's not like we haven't seen this before. Gen AI has the potential to really change a lot of industries, the ones that Nathan did, but just more broadly, any industry that does knowledge work, and even ones that you don't think of, the steel industry or whatever. There's a lot of people that are doing sales and distribution and management that are also going to be affected. And if we had those kinds of numbers, it just makes so many other problems easier to deal with, because Bob Gordon is right. We have some headwinds in aging population, less education, growing budget deficit. And we need something like hopefully higher productivity growth that will make it easier to deal with Social Security and the other looming challenges we have ahead of us. And I'm optimistic that we can convert these technologies into business value by adopting them more widely in the right places.
So one of our audience members points out that if you listen to the dialogue broadly today, you might think that AI is the only technology, but it's not. And what do we think? But do any of you have thoughts about what other technologies might be important contributors to productivity growth going forward?
I'm happy to
go ahead, Nathan. You go first.
But also very much want to hear what Eric says. I think that's a fair point. I think that at present AI is first on the list, and that strikes me as the most transformative. But a couple of years ago, I was still talking about upside risk to productivity, maybe with a little less confidence than I have now. And I was pointing to virtual technologies that I think are potentially yet transformative, and we're utilizing that today with this webinar and communications technologies. I think there's absolutely expansive technological progress regarding the human genome and in medical science that could be hugely transformative. I think the list of, in the green space, we're making progress. You look at where EVs are relative to 10 or 15 years ago, we're in a completely different place there. So pretty much wherever you look, you see evidence of technological progress. And I think that was true even before the pandemic. The challenge has been, and I think this touches on some of what Chris was saying, is getting those cool technologies diffused into the capital stock more broadly and getting them adopted and maybe harnessed in some cases. But in others, it's getting them adopted. Pre-pandemic, we saw the firms that were best in class broadly investing and their productivity was rising and they were adopting new technologies. But large swaths of various sectors weren't investing and they had lower level of productivity. So there's a real issue that we were seeing pre-pandemic, and we'll see how it plays out post-pandemic, on technological diffusion.
Eric?
I agree with that. Let me just underscore 3 parts of it. I think that the energy is probably the biggest non-AI related upside surprise, particularly solar and renewables. They can keep beating what the projections were. In the longer run, I think there's some potential for nuclear, both small modular reactors and perhaps further out fusion, but there are regulatory issues that may slow those down quite a bit. But it is true. There's a lot of talk about AI, and a lot of it is hype and nonsense. But there's a core there that is really transformative. I see this as a technology that's bigger than any of those earlier waves and the internet and early other technologies. So it does bear a lot of attention, and it's going to affect these other industries are going to be transformed in part because of AI. So synthetic biology and scientific discovery is being turbocharged more broadly because they're adopting AI techniques. So that's going to have these spillover effects. But ultimately, our ability to transform our businesses and adopt them is the big bottleneck. That 90% of the transformative cost, effort, intangible assets are in adopting the technologies, not in inventing the technologies. And we still have that bigger part of the icebergs ahead of us.
In that light, let's also talk about energy. And Nathan, you mentioned the clean energy transition. In the long run, let's talk short run, long run. What's the impact going to be on productivity?
So I can say a little. When people first started talking about how these data centers were going to use up so much electricity, I was actually kind of skeptical. I looked at the data. It's true that we have a lot more compute in data centers over the past decade or so, but the amount of electricity actually hadn't really moved a whole lot as a share of the economy because the chips are getting so much more efficient, even as the amount used was going up. And so Kumi's law, this improvement in chip efficiency, was offsetting it. However, then when you look going forward, the very aggressive projections and investments that Microsoft, Google, Meta, all the companies are making are going to overwhelm anything we could hope for in terms of greater efficiency on the chips. So we will start seeing the data centers consuming larger and larger amounts. And if you look at the most sort of aggressive, optimistic uses of the technology, they go on what are called scaling laws, where if you increase the amount of compute applied to the problems, you get a predictable improvement in the performance. And so they're just marching down that scaling law, which is 10x, 100x, 1000x increase in the compute they're applying to them. Those numbers get very big very quickly and start having a material effect on energy demand in the later, going out a decade or so.
Nathan, thinking about the energy transition more broadly, you've both talked about EV, you've both talked about solar. Chris talked about electrification. How does all of that fit into the broad productivity equation?
Yeah, when I think of the green transition, I think of some potential positives and some potential negatives. I'd say on the negative side of the ledger, the reality is green transition is going to be an adverse supply shock. And specifically, what you've got to do is you've got to start pricing an input to production that it essentially traditionally been priced at near zero. And as you need to start putting a price on carbon, either explicitly or implicitly. And that's likely to mean higher costs of production and is likely to be a headwind for firms. And there are various ways to embed that. That could be taxes, it could be subsidies, it could be an explicit carbon tax. There are lots of different ways to do it, but I think it boils down to the same thing. Now, the positive side of the ledger is that one of the features of the green transition, and McKinsey has written about this very cogently, is it's going to require trillions of dollars of new green investment. I think one recent McKinsey report estimated $3 to $3.5 trillion a year of new green investment over a 30-year horizon, which is a staggering sum. But when you think about all of that new capital that is put into place, I deeply believe it's not only going to be greener capital than what we have now, but it is also likely to be more modern capital and embed other kinds of technological improvements relative to the existing capital stock. And so I see that investment boom as potentially being a very significant driver of productivity growth going forward. So maybe I'd say the supply shock effects may dominate a little bit in the near term. Over the longer run, as we get serious about it, and I think that's going to be a key, will there be enough of this investment to really move the needle for the macro economy? But to the extent that we do, I see a scenario where that's very supportive and constructive for productivity.
So for all of this, investment is clearly essential. Chris talked about how in some of our recent research, we've seen that a lack of capital deepening or a deceleration of capital deepening has been a real drag on productivity growth. He also mentioned, though, that money has been cheap, and so why aren't we investing? What's your thought on that, Nathan?
The performance of investment since the GFC and maybe even for some years before has been very soft. At times, this has been called a corporate savings glut. And I think that what's going on here is the underlying macroeconomy has simply been soft. And I think that we felt the first wave of effects associated with aging. Coming out of the GFC, there was significant debt deleveraging that was weighing on the economy. I'd also hypothesize that maybe rising inequality could have been at play. When you think about inequality, you're moving resources effectively from those at the lower end of the distribution who have high marginal propensities to spend to those at the upper end of the distribution who have lower propensities to spend. But a lot of factors have been in play over the last 15 or 20 years that have contributed just to a lack of nominal demand in the economy. And really, that's what the central banks have been responding to, is that lack of demand and a lack of price pressures. And so I think that embedded in there has also been soft demand for investment goods. That the number one factor that you need to think about in framing investment demand is, do people expect there's going to be final demand for the products they produce? And especially in some kinds of investments that are long horizon. So I think that's the key factor. One other point that I think is of great importance that I want to emphasize is relative to pre-pandemic, we have seen a marked slowing of trade growth.
Right.
I think that the expansion of global trade in the years before the pandemic, and particularly during the 1990s, was a key driver of global growth, and particularly in the manufacturing sector and global productivity growth. And post-pandemic, the sensitivity of trade to real GDP. Trade was growing much faster than real GDP, and real GDP was growing very rapidly in many of the years before the GFC. And post-GFC, they both have declined. So that's another, I think, big piece of the puzzle. And I think that's macro. It may also have some hints of protectionism, which are certainly in play now more than they were 10 years ago.
Yeah, both of those things. I think it's tragic with 2020 hindsight that we let demand be so much below potential for most of a decade following the Great Recession, and trillions of dollars of output were wasted. There was a misplaced fear that inflation was going to get out of control when during most of that period it was at or below target, and unemployment and slack was above target. So that's kind of gone. Then we overshot in some ways afterwards with some really high stimulus and what happened with the with COVID. But we saw that the economy was able to absorb a surprising amount of that, maybe not all of it, but it just sort of showed that there was a lot of latent capacity for additional output. And one of the reasons the U.S. has been outperforming most of its peer countries is that we've been more aggressive on some of those directions. And I think that also may play into the productivity numbers we said earlier. There's not as much incentive to find those productivity gains when there's a lot of slack in the labor market, a lot of unused capacity. But as you run closer to a full employment, then there's managers are going to look for more ways to get the productivity gains.
So looking forward to the next 25 years, our research looked at the past 25 years.
Yeah.
What needs to happen to push excess savings towards productive investments? I mean, is running hot enough to make that happen, or what else should we have in mind?
Well, that's just a small part of it. I like those three different charts there. I'm closer to the more optimistic of the three, but somewhere between the middle one and the more optimistic one in terms of how it's going to transform the labor market. I think it's partly the macro, but it's more down at the micro level of thousands or hundreds of thousands of small decisions that managers need to make. And I think having a clearer roadmap of understanding where the benefits are and where they aren't, and spending more time on it's just sort of a lot of nuts and bolts of this particular technology can work for this particular application. And some of that's trial and error, some of that's diffusing the knowledge. But part of it is also dynamism, that as things change, you're going to lay off some people, hire other people, move some people to different industries. That kind of micro efficiencies pull up ultimately to the overall aggregate productivity growth.
And Nathan, from your perspective, I mean, of course, respond to anything that Eric has just said, but also what's the role of financial institutions in channeling investment to productive places?
Yeah, what a great question. It's something that I've spent a lot of time thinking about. And I think at the end of the day that what we need from the financial sector is for it to play its classical textbook role of effectively intermediating between savers and borrowers, between those with excess funds and those that have projects. And in the process of doing that, taking measured, disciplined, calculated risks. And I don't think there's a lot more that the financial sector can do than that. But we've also seen, arguably over the last 20 years, it not fully achieve those objectives. And specifically before the GFC, they were plenty happy to take lots of risks, but they weren't calculated and measured, and ended up being an explosive crisis. And I think then there's an argument that at least in the banking sector post-GFC, that some of the lessons were overlearned, and we had period, an extended period of very soft credit growth in the United States, even more so in Europe, which is more bank dominant. We weren't seeing banks being willing to expand intermediation to the same extent. Part of that was a regulatory response, and there are good reasons for that response. But the reality is that the banking sector has been very constrained. And this then suggests, another important observation that differentiates the United States from Europe. And that is that in the US, we have a very diverse financial ecosystem where there are lots of different ways for firms to get credit, major financial markets, private credit, venture capital. It's very, very flexible. And I think that's a source of strength. And it's important that we continue to encourage and facilitate that diversity in the ecosystem. And I think that's a clear advantage that the United States has over Europe.
So let's move to some questions from the audience. Somebody asks, and thank you all you've been asking questions throughout. Please keep them coming over the next 10 minutes or so. Eric, I guess in the first instance question for you, somebody asks, if I'm a CEO, how should I think about creating business value by leveraging Gen AI? And I did hear you say, think strategically and broadly, but at the micro level. But
right. Well, this is what every CEO is being asked by every board. Every board of directors say, what is our game plan? We need to leverage it. And they should be, because this is a really transformative technology, and all the C-suite is addressing it. And right now, there's a lot of stories about different ideas. I think you need to be data-driven and organized about it. And I've come to believe in this task-based approach that I mentioned earlier. And I know folks at McKinsey are working on this as well, where you can go through the individual tasks, not at the level of the industry or the company or even the occupation, but each occupation consists of individual tasks. So people talk about radiologists being replaced. Well, it turns out that radiologists have 27 distinct tasks they do. One of them is reading medical images, and AI can help with that. Others are interviewing and talking to patients, and others even physical exams. And there are things that AI can help with, others that it cannot help with. You go through what a call center operator does, what a legal analyst does, what an accountant does, and you find that there are specific tasks where Gen AI and predictive AI and robotic process automation can help, and other places where it can't. But there's a way of systematically analyzing those and prioritizing them. And then you have a roadmap of where the opportunities are. And now when all the folks in your organization are coming to you, hey, I need 60% of the budget. No, I need 60% of the budget. You have a basis for prioritizing those. And by implementing the most promising applications early, you should be able to start getting the kinds of gains that we saw in those case studies of 15, 30, 50% productivity gains in particular applications. And then you start building a flywheel of confidence that the organization sees that, okay, there's some benefits there. And the other thing I would emphasize is that a big mistake that managers make too often is they think of this as a replacement technology, that AI is going to replace what their workers are doing currently. That's sort of mentally the easiest thing to do, is look at something and say, okay, how can we have AI do that job? In practice, it almost never is a replacement technology. It tends to be a complement that allows the workers there to do things in a new way. It takes a little more creativity to think about what are the new things they can do for the customers, how can they improve quality, or sometimes how can they just do their job more rapidly. But by thinking of it more as a complement rather than a substitute, not only are you more likely to get bigger gains in our research, but also it addresses some of the organizational resistance. The number one fear that you hear Americans have is that their jobs are going to be replaced. And when a CEO brings AI to an organization, there's inevitably going to be some resistance if they see this as a job killer. But that's not the way to bring value for the stockholders or for the employees. If you think of it as augmenting rather than automating, it turns into much more of a win-win.
Nathan, a question for you. One of our listeners notes that the population of advanced economies is aging, and asks, well, what are the productivity impacts of that going to be?
I think this is one of the really interesting questions that's out there. When I look at the experience of Japan, which in some sense has been a trailblazer in the process of aging, I think a clear conclusion is that over the last 10, 20, 30 years, the Japanese economy has felt to me like it has simply been less dynamic than in, say, the US economy or than it was before. And it does open up the hypothesis that is it possible that an aging economy is also one where there's less appetite for risk taking? And that could manifest itself in reduced entrepreneurship. And we know that entrepreneurship is a key driver of economic growth and productivity. It could manifest itself in a reduced appetite to fund projects that are well advised, but still relatively risky. Will there be the same flow of risk capital to support entrepreneurship from others? So I think that the balance of evidence, when I look at Japan, at least, leaves me a little bit cautious that we might be in a world of reduced productivity growth as we're aging. Now, I do think that, and I just wrote an editorial on this, that there's also an argument, though, that, yeah, we'll be aging on the one hand, but then we'll be enjoying the fruits of AI on the other. And maybe the solution, quote unquote, to aging demographics is broader implementation and adoption of AI. Maybe that solves our problem, Olivia.
It certainly mitigates it. My friend Hal Varian, who up until last week was the chief economist at Google, wrote a fun little paper called Bots and Tots, and he highlighted that the demographics is one of the most predictable things. We know how many 50-year-olds they're going to be, 20 years from now, et cetera. And so we certainly have an aging population, which, as Nathan was just saying, is going to affect the labor supply. But then the bots are coming in to try to address that. So it may offset, it may overshoot, it may undershoot. I don't know if it's exactly going to match it up, but it is they are going in opposite directions.
Now, I will paraphrase one of our questions here, Eric, as a follow-up on that. I think it's fair to say that one of our listeners has noted that a 50-year-old may not be as good at adopting new technologies or perhaps interfacing with Gen AI as, say, a 20-year-old or a 30-year-old. How do competencies of that sort feed into this discussion?
Yeah. So yesterday I had Reid Hoffman come speak at my class at Stanford. We had dinner, and he wrote this terrific little piece about, millennials, Gen Z. He calls them Gen AI because they are just used to, in doing tasks, having AI be kind of a partner along with them, not replacing them, but when they write a memo or do some coding or whatever, there is a co-pilot, an AI co-pilot that's helping them, and it becomes much more natural to have almost a conversation and interaction with this AI agent that's helping them. So that is something that those of us who are older, it's not the way we've historically worked. I think we need to learn how to do that more effectively. My son does that quite a bit in his job. He does coding, and he says it's been a huge productivity gain. So that is something that's a set of tools that people are embedding in their daily lives, both for work and for leisure, in a way that older generations just have never done.
Well, we are nearing the end of our time, so I guess it seems fair to say that you both are optimistic, and the question is really, what's the time frame for that optimism? But I heard a little bit more optimism in the US than in Europe, at least as things currently stand. That's
right. Well, just to understand, I'm definitely optimistic about what the potential for the technology can do for productivity, which is a main theme here. We did touch on that there are some risks as well, and so we're going to have to navigate those. It's not an unconditional optimism that all we have to do is sit back and wait for these fruits to arrive. There's going to have to be a lot of hard work to figure out where the benefits are, and also to navigate both the known unknowns and the unknown unknowns of how this is going to affect. We have an election coming up, billion people voting around the world with undoubtedly a lot of deep fakes and phishing attacks. I was just reading about a hospital being ransomed, and other risks in the labor market through the disruption. And by the way, the way to address that is not to try to freeze the existing jobs in place and make sure nothing changes. That's a far riskier strategy than having a more dynamic, flexible economy. And ultimately, there are even some risks, some geopolitical and other risks that we're going to have to navigate through. So it could be a very fraught 10 years ahead. But if we are highly focused, I think we can reap those productivity gains and make it the best decade we've ever seen.
Well, we are at time. And so with that, I will wrap us up. Eric, Nathan, thank you so much for joining. And thanks to all of our audience. We, if you have the time, would love your feedback. So thanks for joining. We'd love it if you read our report. And if you scan the QR code here, you can both get the report, and coming up on the screen will be a place for your feedback. Thanks again.